Um, Microphone. All right. So again, repeat. Sorry for the groggy voice, but first thing in the morning, we're going to analyze directly the S&P, the patterns that I'm seeing reemerge, and some of the economic details happening, including what we had earlier as our inflation values, which are going to play a uh, big effect on what's going to be happening soon. So it's going to be a long video, heads up, but it's going to be specific to our S&P overall market perspective. So it might have no entertaining value, but tons of educational value. And I probably won't be going extremely fast as I'm still processing my coffee. But so let's get started. Okay, so all of our charts here that we see are going to be the daily. Well, they're on the daily. So the VIX volatility index is on the daily candles. The put to call ratio is on the daily. But I have my SPY up here on the 4-hour chart because simply it matches well with the other two. Now we're going to be focusing on a few pieces here. First, I want to focus on a pattern that I saw emerge here. This is the COVID crisis, the 2020 March issue you can see here, right? There are some particular effects that happened within this time. But you can see the response of the put to call and the VIX and other indexes we're going to take a look at. So the very bottom of our correction, we can call it, pretty large correction. What was it, a 50% correction? About a 40 something percent correction. Matches with our put to call here. Here, the put to call. So the bottom is essentially near where our put to call ratio, which I'll explain also. Now, here's the pattern. First and foremost, let's take a look at the pattern that I see happening again on a much bigger scale. Right. First, you have to consider a few factors as the time goes, right? We have a constant growth process. Everyone's very, very confident and happy about our market. Then we have a bit of a slip. This and back in the day was not very known why it happened, but it happens in many cases. You can't go up without going down. However, we have that same upward trajectory and then down here on a much bigger scale. We just experienced the slight down. Now for us, now we do have some details, including Rosenberg or a bunch of insiders in the federal government that sold. They sold some of their stocks and potentially sold based on insider information, which is highly illegal, right? So there's a bit of a fear, and that's what happened before. A little bit of fear happened. And in the current day, we are seeing a kind of breakout from that fear back into a possible upward channel. All right. So this is a nice move, but based on the patterns before, we do see a possible breakdown again. And here's what happened last time. Potentially, this could be a few insiders also selling within this fear trend here. We did break out and continue into a positive trend. But then we had a bit of a huge dip here. This is where most political influences, big CEOs, just basically the big boys, the big money makers, they sold here. And as we know in the future, there were a lot of Well, there was a lot of inside information. Trump as well knew about this. He was given information about the level of magnitude that this COVID crisis presented. But this was in February, before we actually experienced any big news about COVID. No? So the big insiders sold off, they got their gains, and they left the market. Maybe some bought back in, maybe retail investors bought back in, but they gave us a little bit of a small recovery. An upward trend. Very small upward trend, just for a brief couple of day moment. Then fear really got released. This was on the news. COVID this, COVID that, isolation, quarantine. This is where the main chunk of the market and the retail investors began to sell off. Now we can see that constant gain, small fear, recovery from fear, insider sell-off, recovery from sell-off, and then retail sell-off. That's what my pattern is when I'm looking at this situation. A 1 up, 2 down, 3 up, 4 down, 5 up, 6 down, right? And that's basically what I'm looking for with the next setup here. I noticed that my stream is not named correctly, so now I gotta go back and fix all that stuff, but I'll have to fix that in a bit. That's great. I love when I just don't do anything correctly. So we have the 1 up, 2 down, fear recovery, which we're stepping into now. We should be stepping into which we're stepping into now. Fear recovery process here. Now, after that fear recovery, we will have our big insiders, or should have our big insiders selling off. This does include political influencers, just basically politics, anyone in the political spectrum. And potentially it's going to be basically big CEOs, anyone that has any insight or, well, insight on the actual market, right? Because we as retail investors don't quite know what's going on with the latest information. We're kind of given it late for obvious reasons. They want people to buy so that they can sell. So they need somebody to buy in order for our buyers to overwhelm the sellers, or at least not drastically break it down. Buyers to overwhelm the sellers. So that's why they keep the fear, not drastically break it down. Buyers to overwhelm the sellers. Potentially it could be that's why they. So here's where essentially insiders are trying to sell in most cases, just like the previous pattern back in 2020 March. This is where our big correction should happen. Then we're going to see a little bit of a fear recovery, or the retailers buying up. Finally, the bigger drop here will be where the retailers begin to sell off, and possibly others, but a majority of fear in the market. So that's the 6 pattern that I noticed here that could possibly come into fruition. So far, it does seem like we are stepping into the recovery from the small, mild sell-off here. Yeah, let me just do a little bit of changing here. good at this. All right. So that's the pattern between our COVID crash versus our potential bigger crash. Now, I've aligned it basically with resistance. The bottom of our insiders selling off will kind of correlate with what we had back here as far as support. And then finally, we may actually have a good catch from a huge possible crash down at the bottom of where the value was for the SPY during the COVID crisis, right? We could stop there and we could become positive into a bullish run again. The timeline is unknown. I've aligned these trends a little bit on the whim, so there's no particular pattern happening here. But in essence, it should be something of that form. It could be a smaller time period, it could be a longer time period. So far, if this is the case where we're currently in a positive trend, I can align it to a shorter time period, because then that means most of my values are slightly too long. But we'll have to see. There's no prediction in time. All right, so that's the possible trend path we're going to take. But it's always the case where insiders are selling, right? So this is why these patterns can actually be fulfilled again and again and again, because it's the same events, the same time. As long as there's bad news, there will be people that get scared, and especially those that are insider trading. They will seek to leave the market first before anyone else does. That is the reality of our life. There's ways to attempt to stop insider trading, but you cannot prevent all insider trading. So the pattern will exist where it slowly drops, it recovers from that drop. It slowly drops, it recovers from that drop. Then goes down further, faster, and potentially the third drop will be the fastest of all three. But looking back at these two, they're pretty similar as far as the slope they go down in. So this downward trend and this downward trend, they should be similar as well. But those aren't predictable to the T. Now, as far as the values happening around the volatility index, we do see hiccups, some pretty big growth. My particular eyeing is above 30, okay? Above that 30 value, and we see big drops happening. So here's kind of what I'm looking at. I zoom in here, look at the correlation between our historic crash here, even further back. Yeah, around here. I mean, you can't really predict that, but look at that gap happening here. As soon as that gap happened, we saw that there was some issues happening. But we have had bursts from 12 to 18, big gaps. So we should really definitely take care to find gaps in our volatility index. Those gaps could predict a possible futuristic issue. So we can say that it definitely, the crash definitely began around this green candle, which was a close of 1556, and our SPY close was at 336, which is a negative close, and the green candle came through. Again, this is the daily candles, so this is actually daily, day-to-day comparison. Next off, we saw a negative red candle on the VIX, but it did still go down further. And then finally that jump, which escalated our downward trend. So I would be always watching and be cautious over the 20 mark. And specifically if it gaps up over 20 very quickly. This one actually gapped up to 21 and then increased further to 24. So a gap up on the VIX plus a positive candle after that gap up is pretty red flaggy. The continuation was of course really bad. And if we take a look at the put to call ratio on the market, how many puts are there compared to how many calls? Something of a similar here value. Let me zoom in. Yeah, so you see definitely an increase. It was red, which means more calls. The lower it goes, the higher the call ratio values are, meaning more people are going long, meaning a stable market. But as it increased here with our S&P decreasing and our volatility gapping up, here's a big green candle on our put call ratio and a big gap up on our volatility index, plus a correlating downward red candle on S&P 500. Those three coordinated values should be a signal for a downtrend, at least in the recent market. We can't say that they've always been that way, but the recent market is much different than the market used to be. So based on the COVID crisis, this is where we saw the full-scale ignition of our downward trail, right? Now it's not so good to see high values on the put call ratio. In essence, what is the put and call? Well, people make money when the market goes down and when the market goes up. A put is when they make money on a negative down market, when the market goes down. A call is when people make money on a stable market where they expect it to go up. Sometimes it can be overinflated. Too much of a put value will give people the reversal. People tend to buy on fear. So when they see fear going up really high, they normally expect to buy in and reverse that trend. So inflated values on either put or call side will normally reverse, but we can tell an inflated value here is about 3. It's really, really inflated. In fact, we can say anything above 2 is quite inflated. I personally would say anything about 1.5 is too high. A 1 value, a equal 1 value, just means that there are equal puts and equal calls, meaning that there's equal amount of people betting that the market will go up, as are equal amount of people betting that it will go down, 50-50. It's undecided. In our case here, we had a huge 3 value, which means that people saw that the reversals happened. So this is also how we can catch that reversal, right? So let's take a look at some further details. Gap up, downtrend, big increase in put and calls. This is our key to a negative market. But a ceiling, a resistance level that we do not pass, a overinflated put call ratio, and yeah, it wasn't perfect. It did go down a little bit further, but you have a good bet on buying around this area, right? It's like a car. When you slam on the brakes, it's not going to stop instantly. So people were slamming on this brake For our fear, when people get fearful, buy. When people get greedy, sell. That's the concept that kind of runs the market. So when this downtrend went so far, people noticed that there was high fear and began to buy up the dip. Whether it's people, and I use people interchangeably with algorithms, with institutions, with banks, hedge funds, individual traders, anyone that exists and breathes, right? Well, algorithms don't breathe, but they are created by people that breathe. So regardless, people generally, whether businessman or individual, right? When there's an extreme level of fear, people buy the market. And when they buy the market, there is a sign of reversal, which is good. We want that. This is what's going to essentially save the market after all. If people kept selling, well, we're not going to see anything going good for us. But there is a level of oversold, where it just basically means it's just gone down too far. Someone's gonna buy the dip. They see it as a cheap possibility. Normally, retailers get too scared. Big institutions buy the dip, cause the reversal. They get in at the lowest possible price, and then retailers come back in as sheep and buy it up and then reverse the trend back up. But with the current abilities of the new retail market, I think we're a bit smarter than that. So, keeping an eye for a crash, we're going to take a look at what's happening now. We're not generally here yet. We don't quite see this, but we should, within the next few months, we should see something of this form. These three signals for a big market correction, right? Right now, we can say we are in the reversal here. So currently, we are here. We had a big up, and then it's cooling down a little. And the put to call ratio, we are somewhere around here as well. A bit of a cool down. And we're essentially looking at this reversal from the small fear that we had in the market to a possible higher fear that could happen. So since we are technically here on the pattern, we should see a downward VIX cool down. We should see a downward put call cool down and a gradual increase in the market back up to probably high highs, newest highs on the market. So if we take the same exact analysis and go up to where we are now, we have seen a bit of a VIX explosion, right? We had a VIX volatility growth near to the 30 values. 30 values are probably going to be the trigger spot. If we can close and stay above the 30, here we almost did. But here's the other mini crash that happened over here. Right? This was above the 30 values. And we had a pretty big correction, about $100, $50. So entering here in our current daily analysis, we should have seen a bit of a put spike, right? People putting, it's increasing slowly. It's going above the 1 value. So because this is essentially a fraction, the put call ratio is like this. Puts on top, calls on bottom, right? If you have a small number of puts, let's say 2 puts, and we have 10 calls, we're going to have a small decimal, 0.2. And essentially that just means that more people are using calls. So the value goes down, which means a good market. So that's kind of the weird thing about the put call ratio. The smaller the number on our decimal, the higher number of calls, meaning calls are long-term um, long-term sentiments, a stable market. But if we reverse this and put the 10 on top and the 2 on bottom, well, then we have a 5, a whole number. And the higher we go up, the more puts there are, which means a negative downtrend sentiment, right? So the higher this value goes, the greener the candle, basically, the higher chance for a negative overall market. A 1 is like dividing a number by itself. The 1 is the balance. And because the market generally tends to move up, or at least our S&P and our major indexes, we normally see a healthy call spike at the bottom. We like to see these small decimals because higher numbers of calls, more people predicting a positive future. But as soon as it breaches the 1 and goes above, we start to see some form of negative sentiment, people wanting to bet against the market, right? We've seen this especially during big market crash situations. Okay, especially here, which was the March 20 COVID situation. We can probably even go back to the 2008, but I'm not going to go that far. So the overall judgment here is above the 1, not so healthy. Here on the VIX, based on possible triggers, I see 30 as a trigger, above 30 for a pretty decent trigger on a market crash. A stable VIX would probably be around the 10 value, up to maybe 15. So having the VIX between 10 and 15 is good. But 30 is kind of a issue. So here's 2019, pretty decent, 10 to 15, 10 to 15. If I drop back to a monthly basis, let's see, pretty far back, we've had a couple of times of stability from the 90s to the 96s. Fair. And then the 2000 crash kind of stirred up the prices, the fear. Then we went back down, 04 to 07. And then the 2008 crash above 30 gave us a huge issue. And then we had a long period, 2013 to potentially right before COVID, 2019, with some spikes. But most of it was pretty stable. So in retrospect, that's what we're looking at. Well, now currently the VIX is above our stable 15. It's not bad, but it's not good because we are steadily approaching 30 values, potentially going to break that, kind of predicting our possible issues here. This would break our 30. This downward trend should break our 30 on the VIX. It should also break our 1 on the call and put ratio. We are on a cool down now for our put call. It looks like we're also on a cool down for our VIX as well. But potentially, if the pattern continues, and if we have a nice upward movement, we're going to have a cool down on VIX and put, then nearly instantly, we should see some sort of huge sell-off or mild sell-off from insiders. Then a retail recovery, and again, a retail fear. Who knows? It could be triggered by news. It could be triggered by inflation. It could be triggered by just another COVID strand or evolution, whatever. I don't know. But the case situation is that we are repeating some of those signals. We have a bit of a gap up here, but it was filled, so nothing crazy happening. But somewhere around potentially here at the end of the year, which would be very interesting, December 2010th. I would say somewhere around there, so call it December in general. We could see a spike somewhere in December on some issues to happen, which could be kind of a transition, honestly. A lot of news in the crypto market stating that crypto is going to be all-time highs by the end of the year. And normally when crypto goes up, it's because of hedging against the US dollar, the economy going down, inflation, and countless other systematic economic issues. Crypto is, in essence, the new gold of the generations ahead of us. So when we see some sort of odd prediction of crypto going up, I can see also the effects of that crypto going up being caused by a negative market sentiment. And we do have pretty big sort of consideration happening here around the December area, especially currently. What happened recently? Let's take a look at some CPI data. Well, first and foremost, political leaders have reset our debt, or at least extended our debt, the United States debt, at least until December. So that's a thing, correlating pretty well. So Senate extends debt till December. I think it was December 15th. So here's that. So that's a bit of a key takeaway here. Sure, we're resetting the temporary, avoiding default with some debt ceiling limitations extended, but it's only until December. Again, that key value, that key area of effect. This happened just a few days ago. Oh, yesterday. I think it happened yesterday. I can't remember. So that's going to be a thing. December is essentially the October 18th, past the October 18th, economic calamity if the country blows, past the October 18th deadline. So we have about the 18th, call it, for the debt ceiling to take effect again, for the fear to come back. But that's kind of predictable because we had a inflation fear. Now the Senate passes this bill and it's going to go back up. Maybe it's almost on mechanically purpose, right? The politicians need people to buy. So they need confidence in the market, even if temporary. So when they want to sell their shares, they got to sell it to somebody that's buying. Otherwise, they can't sell their shares and they're stuck holding a bag. So the issue here could be systematic, where not only is this repeating itself in the charts, in the pattern that I laid before you, but it's also repeating itself in the way that actual functionality of the system works. In order for politicians and insiders to sell, they need people to buy. So in order to have people to buy, you have to have a confident market. Otherwise, they're not going to buy the SPY. I'm not buying the SPY. I haven't bought the SPY probably ever, honestly, because COVID and all this other stuff. When I finally got into investing, I just didn't see the SPY as a stable at the moment because it was I felt like it was overinflated. So I'm not touching the SPY. And there's a lot of people that feel the same way. If you look all over the net, Reddit threads, a lot of people are staying away from the SPY because they see something sketch happening. And the sketch part is that they're probably just raising the debt ceiling to raise confidence so people get on the buying train again. So it's a game of musical chairs. How much can we go up until all the insiders and politicians leave first here? Right? That's the situation at hand. So they're trying to recover a confident process in the market, getting people to be confident in buying with a question mark of a deadline. They could extend it again, but could stop in December, but they could also extend it again, right? They can continuously keep extending and randomly say, okay, we're not extending it anymore. And then boom, the crash happens. the insiders trade out. So whether you want to call it trending on technical analysis or patterns that you find in the past or actual systematic political incentive, I see it as a possibility, a high possibility of this fulfilling itself. So right now, the first day that our little debt ceiling was extended until December, we see some positivity. We have a little bit of a positive breath here. We broke out of the down bear trend or the bull flag. We're going up. We should be kind of going up for a bit, probably staying between the middle dotted line and the top. And here in the 10th or the 15th or the 18th or somewhere around that line, it could be completely random. The insiders are going to say, hey, we have a lot of confidence in the market. We're going to start selling because we still see negatives happening. Not to mention, we're looking at a psychological value, 490, close to 500. Now, they won't let it get to 500. There may be one bar that makes it to 500 before it drops down completely. But these psychological values are going to be the next resistance. So we're met with political incentive to have people buy, restore slight confidence in the market with an extended debt ceiling. We have approaching high resistance values. We have a pattern that has already happened in the past multiple times. And we have an overinflated market. And there's just so many pieces of information that lead to this pattern happening. There's so many bits and pieces. If I only had one of those, I wouldn't be confident in my assumptions. But because there's so many things, including political incentives happening now, it makes me kind of believe my own analysis based on multiple perspectives. And inflation. Let's take a look at that. So, a lot of interesting inflation-related details. One was that food is going up, but school food is going down. Is it the quality of the food? Or is it the humanistic efforts to have schools feed people that cannot normally be fed because of outside inflation? But we're seeing a pretty big increase. So energy is definitely being the difference here. All items, boom, going up. All items, less food and energy. Food and energy basically drops it down, but food and energy is one of the survival things, right? So food and energy actually are being inflated is a very bad thing. So that's the overall. There's positives everywhere in our inflationary process. So basically, overall, like this is month to month, but overall 5% food increase. Energy, 25% increase. Gasoline specifically, fuel, oil, electricity, not so bad. Yeah, not so bad on the electricity, but definitely big gasoline, fuel, inflation. Some say it's supply and demand issues. One thing that's down is medical care commodities. That's an interesting substitute for the growth. Okay. So the last month, food items going up. A lot of meats going up, I saw. Fuel oil going up, of course. Some small negatives. Transportation, but it's still not overcoming last year's inflation. The sum is not positive. Airline fares going down. Well, That's a need for the airline industry. They need more people to travel, especially in times of less movement because of restrictions and COVID and all this kind of stuff. But you'll see that basically everything is in a positive trend up. Not even just a value that's positive, but over a period of time, we see a slight increase, maybe a slight decrease here, big increase here, 11070412 increase back to 11. So the trend is positive on the increase, 2.5 negative, then back to 2.5. So we're kind of referencing the September 20 to 21 space in our August 2021 to 2021 in a single month versus a year. There's almost no negatives in sight, with a few things like fruit, vegetables, negative inflation on those, cost reduction in some form. Food from vending machines, food at elementary schools, there it is. A very big negative drop, which would mean that they're readjusting the food outsourcing, where people can actually eat. Children can get low nutrition from school, but at least it's something. As the others increase, which was the meats. What were the meats? Potatoes, bananas, milk increase, eggs increase, chicken, chicken staying stable, pork chops going down, mass production, bacon breakfast, etc. 1.8 going up, beef and veal going up heavy, 5% current inflation from the last month. But you can tell the overalls here. Again, September 2020 to 2021, August 2021 to September 2021. So the year and the quarter, right? So we've got a year increase on just about everything. No actual decreasing. Fish went down 1.3 over last year. Cheese went down 1 over last year. Vegetables went down 1 over the last year. Everything else is basically increasing. I'm not going to say every single increase happening. Butter went down, margarine went up. Interesting comparison there. But food at employee sites and schools. See, the subsidiary locations, the places that people can get food that are not freely available to the outside, whether work or school, those are going down, which kind of tells me that they're preparing for distribution from those locations, because there's an issue with food inflation. So they went down drastically. Super cheap to go eat at your employee site or at your elementary school, especially if you're in dire need. And that's one of the biggest weirdnesses that I've seen here. It's almost like a mental preparation for a possible drought in food. Because of high inflation, people will not be able to afford food. So we're going to have shelters and other food provided locations that will provide food for a very cheap value. Energy going up strong, fuel going up, gasoline, electricity not so much, but still going up, utility, okay. General commodities still going up. The inflation is still drastically increasing. Dishes going down. Household products, slight down. Boys and girls footwear going up. Transportation commodities, people going to work, more expensive. Used cars and trucks, again, this was a thing. Big inflation on used cars and trucks. It went down a good amount, give or take. Went up, then went back down. Now it's increasing again. So the whole used cars and trucks, this I can actually see from a what's the word that they keep using? Supply chain issue, right? Used cars are now more expensive because there's less supply of new cars. Therefore, people need cars or need car parts because there's a supply chain issue on top of everything else we've talked about that could possibly initiate a crash. The supply chain issue definitely affects cars and trucks. So even though the news kind of blasts that this whole inflation is only because of supply chain, no, probably the used cars is because of supply chain issues, but school foods going down because of supply chain issues and regular food going up because of supply chain, we can grow our own food here, right? We do that. So there's no reason for supply chain issues, especially if it's from the perspective of used cars and trucks, which is imported values, right? For the most case scenario, most cars in the US are imported and sold on car lots. Of course, now you have a lot of car companies local, Tesla being one of the new car software companies. You've got Ford, Lord Motors, or Lordstown, I don't remember, but they seem a little sketch to me. Um, you've got Lucid, right? They're not really profitable yet. They haven't created much, but Tesla is a very good example of futuristic sort of increase of production of cars. Of course, we have Ford. That's a thing that always existed, but again, most cars come from cheap outside imports. Hondas, Civics, Hondas in general, Toyotas, um, Hyundais, whatever. Those are imported. So yeah, those specific inflation supply chain issues are happening specifically for the cars, but it's not affecting the rest of the inflation that we see. Boys and girls footwear, I can also see that as a supply chain issue because of imports, right? Cheaper clothing imports. But food is specific to the internals of a system, the internals of a country. So food inflation does not make sense. If food went down in inflation and then used cars and clothing went up, yeah, I would say it's only a supply chain issue. It's not even an inflation issue. It's simply because the supply is running down. And there's no way to the shipping crate issue. There's, I guess, limited amount of shipping crates, and shipping crates are becoming more expensive, and etc. Right? So anything shipped from the outside into the US would definitely make sense as a supply chain issue. But when it comes to the food that we saw earlier, that's internal. Why is inflation of food happening? Potentially, it could be from machinery that's being imported, machines and parts that need to repair machinery. But generally speaking, it's most likely going to be a continuous inflation that's happening because the United States printed trillions of dollars to kick the can down on the inflation from 2008, printed money all the way up to 2020 with the next issues that arose, which was the COVID. They had to print a lot of money again, so they're kind of kicking the can so many times down the road that inflation is eventually going to catch up on a major scale, possibly affecting our stable inflation of 1 to 2% a year, probably going to standardize it to about 5% a year, and then continuously possibly keep going up for every major issue that happens in our economy. Television inflation, again, Samsung, LG, imported products, right? Big inflation on the big inflation on the imports. Audio equipment, debatable. Recorded music and subscriptions, that's just like Spotify and stuff. Pet food going down. Food again, going up, sorry, slightly. Pet food, you can also make pet food locally, it's not a big deal. Sporting goods up. Sewing machines. This is also a very weird one. Sewing machines go down in inflation. Mechanically, sewing machines aren't so hard to create. But purposefully, it's almost like a hint at the fact that it'll probably be cheaper to make your own clothing than it would be to buy the clothing later down the road due to the inflation. That's good. So that's another weird hint next to the whole school food and employment food deflation or reduce price. Alcohol, I can't really comment on that. It could be another form of dealing with the issues in life. Some people do that. but maybe that's why, or it's easy to produce in a local standard. Tobacco products for sure going up. Lodging away from home. This is basically going to be hotels. Increase in hotel prices. Housing at school increasing. Motels, hotels increasing. Rent, owner's equivalent rent of residence 2.9 increase. That would actually be one of the big issues. If this increase is heavy, the rent, we already have issues with rent, considering people had to not work for a while and they had to essentially depend on government subsidies to help them with their rents. So now they have to catch up on their rent. But if rent continues to increase, especially at a more rapid rate, we're going to have a really big recession on our hands. People getting kicked out, they can't pay their bills, or the government has to print more money to help them. That is a vicious circle that if rent goes up, people need somewhere to live. And most people will not, forgive the rent, even though it's a humanistic aspect to, hey, I see that there's an issue in the world today, our economy is kind of shit. Use this house and, pay me minimum amount of rent, something that, I can still personally survive. If the rent normally was $500, $1,000, cut it down to 25%. Most people make profit from rent, so cut the profit out. These times aren't so very nice. So if people can be a little bit empathetic to others, we can maybe keep this down. But over a long period of time, people get greedy, they want profit. And I don't know how long we can hold down a rent inflation. Water going up, household operations, domestic services, gardening, repair, dental services. So a lot of services are pretty consistent. They're not so crazy up. Health insurance going down. Interesting, 10% almost. Vehicle maintenance and repair. Big issue here. Probably because of parts. Or maybe potentially labor is increasing because people need more money. Because we can see vehicle bodywork 6%, all the increases here. Wait, this is something else. Oh, car and truck rentals going up very high. So rentals of those makes sense. There's the ship fare, transportation going up. Video discs and other media going down. Entertainment going down. Cheaper to entertain yourself at home through tough times. Club memberships going up. Education communication services mildly balancing. Personal care, miscellaneous legal services going not so crazy. And there's the overall. So we can see there's more details you can go over on the CPI inflation numbers. This was the most recent one, and it's not looking so good. But again, there's a lot of these pieces that keep colliding with a possible stable market. And especially recently with the debt ceiling increase. This is not a permanent solution. December is literally another deadline for another attempt at raising the debt of the United States before being downgraded as a whole. So a lot of kind of hints at a negative possible outcome, including technical details, plus political details, plus economic details. It's almost like negativity is hitting from all sides, and it's almost amazing that we've been able to keep going up so much and still potentially have some upside even further. But you know what the issue is? The issue is this is fabricated. This is not real. You need confidence for people to keep buying. And if you're planning on mass selling your shares, you need people to buy those shares. So the continuous growth is an attempt to keep confidence in the system so that people keep buying, so that at random some insiders, big people sell off everything they have and let us, the retail investors, hold the bag as we go back down with huge negative cash flows. That's the overall systematic issue. The markets are rigged. I don't have to tell you this. I know you know this. I know everyone knows that. Welcome to the reality of the world. Nothing is fair. Just the level of how unfair it is almost sickening. So that's the case scenario. Keep an eye on these details. We kind of went again over the VIX, what to look for in the VIX for the next possible crash. We're on a cool down period for the VIX and the put call ratios. We should see some growth again, but in the next month or 2 or 3, they could extend it again. Keep an eye out on your stocks, on your markets, maybe even make a little bit of money here on the upside. But keep an eye out for any possible dumps happening, because that's going to escalate very quickly. Oh, but that's it. That's the overall aspect here. Nothing further to analyze. I just saw that we had such a coincidental, I don't believe in coincidence, but coincidental event where we broke out of this bull flag just at the right time with the political news that the debt ceiling was increased. And because this changed the direction of our S&P 500, which again looks near mirror image perfect to how it was back in 2020, right before March. Most people think March is when shit went down. No, March is when the retail people saw shit go down. Before that, we still had a systematic sell-off here from all the insiders. A much stronger sell-off here, right? So we are here going back up a little bit, maybe make a new high, but then watch out for that drop. And that's it for me. Keep your eyes open and don't sleep on the market, at least not anytime soon. You're going to need to be fully aware of what's happening.